Hello and welcome to the Investor Master Series. My name is James Boyd. Alongside with me is Barbara Armstrong in the chat, and this is Tuesday morning. We welcome you all. Hopefully you had a great 3-day weekend. We're right back at it. Just real quick, we have Fez with us, Pamela, Fingo, Will W, Dom, Scott Terry, High Speed, Low Drag, and many others. Welcome to all. Now remember, this session is being recorded. I'll show you that playlist in just a moment, so you don't have to kind of say, is this, can I go back and watch certain parts of it? You sure can. And I'll share with you that playlist just shortly. So just real quick, also give us a quick reminder, why the title, Investor Master Series. Some of you have actually maybe taken a class in stocks. Maybe it's actually been in fundamental analysis, technical analysis, options. This class is really designed to really bring all of the information together. Now, that doesn't mean if you haven't gone to the individual classes that you can't learn from here. We're just going to try to put it all together. Now, just real quick, as we get started, as we do that, as we'll talk about stocks, but we will also bring options up occasionally. Remember that options are carry a high level of risk, not suitable for all investors. We will show different type of option trades like covered calls, cash secured puts, verticals, callers, synthetics. Those are probably going to be the main strategies that we really focus on. Now, don't worry, if you watched our classes over and over again, we'll practice those same strategies over and over and over again and try to actually kind of deepen our understanding of how those strategies could potentially work and what the risk is. The information provided here is for general informational purposes only. Also remember that Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risk, including loss of principal. And also remember, when we talk about short options, that means if we sold a call, if we sold a put, those can be assigned, okay, at any time up to expiration, regardless of the in-the-money amount. So that means if you had like a cover call, someone could take those shares at the strike price, even though it's not at expiration. If you shorted a put, they could assign you those shares to buy the shares at the strike price prior to the expiration, not just at expiration. So in our examples, we're talking about American style options, and that can be the case where you could be assigned prior to expiration. Now, also remember, when we talk about this class, I want to start our class with taking a look at 2 sell examples, potentially. We'll also talk about one that's on the fringe, okay? And these 2 examples that we're going to look at initially is Netflix and Costco. Now, I think this is the hardest thing for people to do, sell. And I want to talk about it right up front. And then as we do that, we'll take a look at Meta, okay, and kind of talk about maybe keeping an eye on that. Is it a sell now, or is it maybe something that's still kind of developing? I want to bring this up. And if you struggle with selling, let us know, okay? Now, I also want to talk about some of the indexes and the sectors. This is Tuesday. Monday we had off. What are some of the areas that we're going to be watching and why? What's some of the stocks that we could actually be looking at this week and why? Now, with that, we'll talk about new positions. Our real focus of today's class is we're going to talk about option volume and volatility, okay? And so as technicians, some of us like to look at price. Well, sure. Okay, absolutely. But we're going to talk about really heavily more on volume, stock volume, option volume, and volatility, okay? And then we're going to look at some current positions as well. So let's hop right in. The example that I want to look at first is I want to bring up this position, and we're going to go to, let's start with Netflix first for just a moment, okay? Now, I'm on the paper money account. And what I'm going to do is we have 2 different accounts, right? We got the margin account, which we're going to go more into today, and the IRA. Okay, we're going to look at both of them. Okay. Now, what I want to do is I saw today kind of that Netflix was down a pretty good amount. Okay, down about 25 points, 2%. Now, what I want to do is on Netflix, I want to look and see, is there any positions? So in the IRA, the reason I went to the IRA is because we have a position there. Okay, and our question is we want to kind of evaluate, is there maybe a reason to profit take? Okay, now let me close all these up here for a second, okay? Now, when you look down below, and let me kind of guide your eyes, we have, in this case, we sold the 970 put. We sold that. It says -1, okay? So what do we want in that case? Well, we want the stock to be above the strike price. Well, it is. Okay, it's up above that. We're at 1033. We're up above it by about 60 points or so, a little bit more. This one right there is just protection. Now, you got more than 31 days remaining. And we're sitting here at about 50%. Now, this would beg the question. If we're still at about 50%, where was this before it dropped 25 points? Now, we kind of follow a golden rule of thumb, okay? If we can get 50% in the first 10 days, the investor might consider taking it. That's like a nice trade in a 10-day period of time. If, for example, we could get 65% with 20 or more days remaining, that's like 80% at expiration or closer to expiration. If we're at 50% and it's moving on us, we're at 52% and we still have 30 days remaining. Some people might even take that gain, okay? Now, this one was sitting here close to 65% on Friday, okay? And what I want to do is I want to go back to this, and what you're now going to notice is it's not crossed over, but it has a large bearish engulfing candle. Now, got to ask you a question, okay? I mean, would you consider taking this position off if you're sitting on 50% gain, was higher than that on Friday, and you got 31 days remaining? Now, what type of trade is this? Well, this is a classic short put vertical. Now, I only had one contract. Why did you do one contract? Well, because the max loss on this, we had a $10 wide spread. And if you look at that, that would have been about a we collected $23.80 and you paid, okay, $25. So we had a credit of $355, $10 wide spread. That means the loss would have been $645 or so, okay? So that's why we only did one contract. We widened out the spread, okay? Now, how many of you would consider taking this position off, okay? Now, the comment comes in is, yeah, take the money and put on another trade. This does not mean we're going to take this off, right-click on this, okay? Buy that position. Now we're going to repeat this, okay? If we get 50% in the first 10 days, that's a phenomenal trade on a vertical spread. If we get 65% and there is more than 20 days remaining, that's a really good trade, okay? And if we get, let's say, 80% ever. Now, again, I'm going to say this a third time. James, was this pretty close to probably a 65% gain on Friday? My answer, I saw it, was yes. We didn't have a class on Friday where we could talk about this, so we need to talk about this now. Now, what that means is we had higher gains, okay? And so if we had a class that talked about this, maybe that could have helped the portfolio even more. Now, I want to kind of go back. We're going to right-click on those lines, create closing order, and we're going to close that position out. Confirm and send. Note the commission. You had a commission to get in, commission to get out. Note that. Send the order. Now, I want to go back to just also Costco for just a moment, okay? Now, tell me what you're seeing on Costco. What do you see, okay? Now, if we kind of look up top, we see that the 10-period moving average, 10, we crossed down, okay? So that's not great. Don't like to see that. We're just going to call that number one. And notice that doesn't normally happen like that. Normally you get the 10-period moving average to go red first, and then maybe the crossover. Here, we had a negative crossover. There's one. We had number two happen, which is the 10-period moving average then goes from green to red, okay? And that last thing that would happen to confirm the 20-period moving average going from green to red, we don't have that yet, okay? Now, if the investor said, well, what's the position on Costco? Let's take a quick look at this. Trade tab. We're sitting on 65%. Ooh, go back. We said if we can ever have 65% with 20 or more days remaining, the investor might consider taking that trade. Now, the investor could just exit the position. Or they might say, I'm going to exit and roll the position. Why the difference? Well, they might exit the position. When we say exit, we're trying to get out of the position we currently have. If we roll, we're establishing a new position. Why might we not establish a new position here? Because we don't have an entry. So between exit and roll, we're not going to exit and roll because we don't have a new entry setup. This is going to be more of the example of exit. Why? Well, you got 31 days remaining. You're at 65%. Okay. Now, if we take a look at this, what type of trade was this? Is this more of a short put vertical, or is this really more of a cash secured put? Okay. Now, Lisa actually says flagging potentially. That's true. So the more of the story, now, I think we all learned from past, like, geez, what have I learned? Okay. One of the things that I have learned is if you get out of positions, that does not mean that the trend is over. And I'm going to show you what we're going to do in just a second, okay? I'm going to right click on those lines, create closing order, buy that back. Now, when we buy that back, we're giving some of the credit we received initially, okay? So on this trade, we actually received $23.55, okay? And then what we did is we paid $17.10, okay? So if we take a look at this trade, the credit received was $6.45, okay? You collected $23.55, and then you paid $17.10. Net of that, pre-commission, $6.45. We're going to give $2.45 of it back. Now, I know how you feel. We're all children, okay? Just older children, okay? We don't want to give anything back. That's true. But if the investor says on this trade, I'm willing to give some back because there's not an indefinite gain, it's about percentages of the maximum gain, you're going to have to give some back, okay? I'm laughing because my 2-year-old granddaughter pushes away my 6-year-old granddaughter, 6-month-old granddaughter, because, you know, she wants to be held by her father and not the other sister. So you got to watch those kids these days. That selfishness exposes early. Now, I'm going to confirm and send the order. Now, a wise investor and trader would say, you know, I'm going to go back to Market Watch for just a second, go to quotes. And what we're going to do in this case is we're going to put these on, we're going to make a watch list. Market Watch quotes, go right over here to the right-hand side, say create watch list. And what we're going to do is we're going to label this as recently, okay, exited. All right. Now, the one we actually did so far was Netflix. The second one we actually did was Costco. Now, a wise investor would probably keep an eye on these stocks because Lisa is right. And if she wasn't, we would tell her because that's what she would do to us. Now, the biggest thing is when you get these stocks to go up and they've been in this flag pull, right? They go up, 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 up. Just because they pull back and we get a shorter term exit opportunity doesn't mean that that might not be something that might come right back to the upside. So what we're saying is right now, these are on that little pullback phase, fine. But at the end of every pullback, there tends to be a higher low. And we're going to put these, just kind of keep an eye on these. How often are we going to watch them? Daily, okay? Daily. And we're going to look and start to see, can we start to get a bounce? So this becomes a watch list that we're going to watch just as much as we would watch the Dow and the S&P and so on. Now, the last one I just want to make mention of, and I'm going to save the last one, Meta, and I'm going to come back to that for just a sec. But let's kind of speak to the markets for just a moment, okay? So that's how I want to kind of take a look at kind of two examples that were ripe for profit taking or to consider it. Second, I want to go look at the indexes, okay? Now, when we look at the indexes, we just make a list of the indexes. I would invite you, okay, to just make a same list, okay? Make it a habit of what you're doing and why you're doing. Why are we looking at the index list? Well, it kind of gives us an idea of maybe where investors are putting positions or focusing and where they're not focusing, okay? Now, these indexes, they're not just a ticker unto themselves. They're a collection of stocks. And those collections of stocks could be different sectors. It could be different market caps and so on. We want to get a gist in a very small list. Where are they looking? And the ultimate idea of where they could be looking is does the price move up or down? What is trending? Well, if we look at the four that I kind of highlighted, SPX, the SPX, if we look at kind of said which index on a relative strength basis is showing the strongest strength. Well, currently, NASDAQ. Now, NASDAQ has been the most consistent over multiple periods of time. Now, I want to speak to that for just a second. That doesn't always mean it's going to keep going, but the current trend is showing that, okay? Now, speaking to that point, we saw that the Russell had just been very lackluster. But then so far, that's the key word, so far, the Russell is getting a little push. The RS5 is actually ticked back up so far. Now, you'd like to also kind of see that, is that showing really a breakout? We don't see any signs of a breakout yet on a 20 and a 55-day period. We do not see that yet. But what we do see is the whole moving average today, did go green. Confirm that. Script's not guaranteed for accuracy or timing. Check that. But that 10-day whole moving average went green, and the number one is saying it went green today. Okay? Now, that doesn't mean someone has to do something with that. It's just they're saying, hey, smaller caps might be even getting involved as well. Now, remember what we said on Friday. It's not the Russell 2000. What is it? It's the Russell 1000. Okay? Keep an eye on the Russell 1000. The Russell 2000 has really underperformed. And then when you look at the SOX, getting a little bit of a push here. Speaking of this, just want to kind of give us a quick look at what these look like. SPX, okay? If you look at the SPX, you know, we talked about this last week, looking at weekly charts, okay? And there's a point that I want to make to looking at this chart. When we started this portfolio, okay, where were we? We were about right there, okay? So when we started this portfolio, the margin and the IRA, it hasn't really been a straight up move. It's kind of been like trading range, a little bit up, trading range, a little bit up, and starting to be a little bit better. Now, let me speak to that, okay? How many of you have ever watched a baseball game? Got 9 innings, unless they go further, okay? I know that much. How many of you have ever said to yourself, geez, in the 9 innings, they only had runs in 3 or 4 of the innings. Let's just say 4. And if I could have known ahead of time which innings the runs were going to be scored, I could have just missed out on the other innings and just stayed there for the 4 good ones where there was scores. Yeah. But you don't know ahead of time which innings are going to be the good innings where you score. Now, in our world of investing, it's not 9 innings. It's 12 months. And so with the 12 months, there's just months where you kind of more vacillate or chop around. The thing is, when you kind of have more neutrality on the indexes, the goal of the investor is to not to have significant drawdowns in neutral price action. Now, let me kind of just speak to this. I cannot speak to where we started. It's up to you to remember. We're sitting here close to about 107,000. I'm not going to say that this is unbelievable, but given that we've kind of had choppy price action, it's not unusual. Seen it before. If you look at the IRA, they're higher than where it started. That's not a recommendation. You might not trade the same. I cannot speak to where this account started. And so if you looked at this, yeah, it's up, but it's not like barn burner unbelievable, okay? So the thing is, when you go through kind of chop in the market, the goal is that you don't say, geez, I'm down 5, 8, 10%, down 20%, because the market's been chopping. It's higher, so we've had gains and losses, but there's been more profitable gains than losses so far. Now, if this market trends, we're kind of thinking, could we kind of get into an inning or a month where the overall account values kind of swell a little bit to the upside? That's the idea. So if you've ever, now, by the way, if you ever look at Goldman Sachs, Berkshire Hathaway, professional investors, etc., Paul Tudor Jones, you name it, and you look at their returns, you will see something very similar to that. And if you missed the 4 months out of the year, that was probably 80% of the gains. You go back and look at hundreds of examples, you'll find that. Large majority of returns come down to what happens in 3 to 4 months out of the year. Go look for yourself, okay? So now I just want to kind of say that, and I think it's important to bring up. So let's kind of now talk about some examples of volume and volatility, okay? Now, when I do that, what I want to just bring up is when you look at the SPX, we're on the doorstep of kind of making a brand new high. The NASDAQ itself, okay, doink, as Bill would say, that is a brand new high today. Now, we traded the brand new high on the NASDAQ. This chart is showing the weekly chart, okay? And if we drop this back to the daily chart, here we go. Now, when you look at the NASDAQ, it wouldn't be very hard to kind of think who's in the NASDAQ, okay? Now, if you said, James, I'm new or intermediate, I don't know what's in the NASDAQ. Well, get ready, okay? Market watch, we're going to go to visualize. And when you look at the NASDAQ 100 on the left-hand side, the biggest square, you don't even need a magnifying glass. You don't even need your glasses. It's NVIDIA, okay? Now, I think people they think sometimes what's obvious for some isn't obvious for someone else. And I understand, okay? So when you look at kind of the move, the biggest square based on market cap, 3 billion, so this is $3.4 trillion, okay? 3.4 trillion, okay? Or 3,444,000,000, lots of commas, million. That's a $3.5 trillion market cap. Jeez, pay off almost a good chunk of the national debt. Now, what I want to do is let's kind of talk about NVIDIA for just a second, okay? Now, NVIDIA has actually had a pretty good move to the upside as of lately. In the last couple of days, and we're going to look at a number of trades here. You look at this, and I'm going to kind of show some variation. I want to talk about the volume on the stock, the volume on the option, and the volatility, and how that relates to strategy. Now, if you look at this move in the last 12 days, NVIDIA has only gone up 24%. Yeah, that's it, okay? So be very careful in thinking that every stock is like the index, because that's not true, okay? Now, what I want to do is if we go to, let's say, the volume, if we go look at, let's say, let me bring this up on the chart. Let's pull that up. And I want to see which one. Let's go charts. Let's bring up NVIDIA. Now, first off, if you don't have average volume on the chart, quick win. We're going to click on the little test tube right there. And what I'm going to do is just go volume. The volume that we're interested in seeing is the average volume. Okay? And I'm going to double click on that. Now, historically, people learn things like look at the 30-day volume, look at the 50-day volume. We're going to even go closer than that. We're going to go the average volume, not 50 or 30. We're going to go the last 21 trading days. 21 trading days in a month. And what we're going to do is here is when we change the length there, we're going to go volume average. I want a little thicker line. And I want to kind of see that in a little bit different color, a little yellow there. And I just want to kind of see where's the volume now. Okay? So first off, if we look at, let's say, this is the average volume. The yellow line represents the volume, average, over the last 21 days. Now, what you're now going to notice is, so far today, the keyword is so far, we're not at that average volume. I'm going to start with this one on purpose. Now, that doesn't mean that the options are trading flat, okay? If we go look at the trade tab, we see terms like, now, by the way, I'm going to click on the drop down. Let's go to just real quick where it says delta. Let's go where it says position intrinsic. Oh, let's go delta, gamma, theta, vega. Why? Well, we're going to keep delta, but we're going to change one of the headings there to just, let's say, volume. Now, the volume that we're talking about here is not stock volume. We're talking about volume that is traded on each of the strikes. Stay tuned for that. Third, we're going to go to open interest. There. And the last one I'm going to put right there is theta, time decay. Okay, and it is decay, not decay. Now, if you look at this, what do we get out of this? Well, when we look at volume, okay, we're talking about the contracts. So if we buy 100 contracts, well, that would be 100 on the volume. If we sell 100 contracts, that is not netted off. That would be another 100. So if we buy 100 contracts, 100. If we sell 100 contracts, the volume would be 200. Okay? So the volume is really showing buys and sells, and they are not netted off. Now, when you're looking at this, it's not a bad idea that if you go look at, let's say, the options, it may be in the shorter term. Maybe this Friday's expiration or next Friday's and so on. What are you trying to see? Well, what you're going to notice is, now, by the way, when you look at the volume on NVIDIA, it only has 107 million shares traded in less than 2 hours, which is amazing. It's like an index unto itself. Now, if you take a look at this, you're going to see the volume is not quite, it's over 50% of the open interest. The open interest is different than volume. Volume is today, okay? The open interest that's the number of contracts that are still open and they are unexercised, okay? They haven't closed them, but they're still out there. This could be potential future trading, okay? Now, what the investor's really looking for is, are there any strikes that might have higher volume relative to open interest? Well, you do on the 142, you do on the 143, you do on the 144, you do on the 145, you do almost on the 146, and you do actually on the 147. Now, do we know if these are buys or sells? The only one that would know if those are buys or sells is the broker that actually has the accounts that can see the positions, okay? So now, irregardless if they are buys or sells, if you get that much volume relative to the open interest, someone's thinking there could be a move in the price or maybe just time decay, okay? Now, if you look at this, it's not just on the call side, it's also on the put side. Volume, 35,000 compared to 8, 35,000 compared to 13, 17 compared to 13, etc., 39 to 36, and so on. Now, what you're going to notice is when you look down the table, if you go look and see, wow, pretty good volume to the open interest there, and you're going to see a decent amount there. When you start getting about 50% volume compared to the open interest, that's pretty high. Remember, volume is today, okay? Now, if you go down the table and look at this, you're going to see that that's another one that's over 100% of the average. Now, what we're going to do in this case with upcoming earnings, so some technicians, including ourselves, we like to look for price action. Fine, okay? Another way to kind of see interest is volume, option volume, stock volume, okay? Now, what we're going to do in this case is we're going to try to use that volume. That volume can also create volatility. Now, if you go to the trade tab, now what does that have to do with options? Everything, okay? So if there's more activity, there might be a greater forecast of expected movement. Now, when you look over to the right-hand side, you're going to see that this is an annualized number, 77%, an annualized number. That number right there, plus or minus 14, they're saying in the next 10 days, they think the stock, not dollar-wise, could go up or down $14. The key is up or down, okay? Now, considering that this is a $141 stock, they think that stock could go up or down what percent? Well, they think the stock could go up or down 10% in the next 10 days. Now, some investors might say, hey, geez, with that type of volatility, they might say, look, I like to be maybe a seller. And why? Well, they might say, look, I like to actually sell something because if I can sell something, if the volatility is that high, they could go up on the option table, okay? And they might be able to sell a lower strike with a lower delta. So we're using delta as the proxy or the probability of being in the money by a penny. Okay, that's one way to look at it. The other way to look at it is the change in the option price over the change in the stock price. Okay, so first trade that we're going to do here is we're going to sell the 132 strike. Now, wait, if you sell the 132 strike, what is the obligation? Or is it a right? Well, if you sell the put, it's the obligation to buy the stock at the strike price. Now, what if the stock goes down a lot by more than what was even expected? Well, we're going to make this a short, wide put spread. Now, when you say that lingo, short, wide put spread, we're going to pick a long put below just in case. So what it's going to do is it's going to create a maximum loss. It's built in. Now, you could say this is like a classic vertical. It's not if you did $10 wide. If you chose a long put, now how are we going to consider which put to buy? Well, in our examples, you normally look for a delta of less than 10. Why? They don't cost very much. You're planning on that it's going to go to probably zero. That's a very low probability trade that that's going to be worth something. In this case, we're going to widen out, given the kind of the criteria, we're going to even sell the 120. Now, the investor would not just blindly say, I'm going to do the 120. They would actually look and say, what's the bid-ask spread? A penny wide. What's the volume? What's the open interest? Are they liquid? So that way, if they ever did become worth something, is there current liquidity on it now? We're not counting that future liquidity. We're planning on that 120 is probably going to go to zero. But it's not a bad idea to start with positions that have liquidity, okay? And also have open interest. Remember, that open interest could become positions, could become future liquidity, okay? And I'm going to tell you right now, I've seen too many examples where just the volume in the open interest was just, okay, I won't even say the word. I was going to say trash. I won't say it. Bid-ask spread, you could drive a truck through it, okay? This is one of the most foundational concepts. We always talk about volume and open interest. If it's wider than 20 cents, it better be a couple $100 stock, okay? Most examples, 20 cents or narrower, okay? Now, could you do one that's wider than that? You sure could, but then you're going to find out why we have it in the online course. Now, trade number one, we're going to do a short put vertical, 132 put, buying the 120. What's the second reason for doing this? Well, the second reason for doing this is it creates a max loss built in, but it also doesn't tie up as much capital, okay? So that's the first trade here today, NVIDIA. Now, I want to go to a second stock that's in that space as well. Which stock do you think I'm going to pull up? Give you a hint. Starts with an S, then goes M, okay? Let me show you a little variation. S, M, can I get a vowel? If you said I, yes, okay, it's SMCI. Let me kind of show you something. Now, by the way, let's kind of go back to stock volume for just a second, okay? Now, what sometimes a lot of people might not connect is when you're looking at the volume based upon what time of the day. Well, this would be pretty hard not to see. So if you had volume up and you said, okay, here's the volume today, what you need to connect the dots to is that this is average volume, okay? This is average volume. I'm down here. That line is average volume for the day. But if we're currently at 2 hours into the market and we're already above the average volume, and we're not even halfway through the market day, this is explosive volume. And that's on the stock. Now, some people would choose to trade that direction, maybe based on buying the stock. And I'll show you an example of that in just a moment. But someone else might say, hey, I'm going to go look to maybe trade the options on that. And what I'm going to do is kind of just show the example. Now, once you see it, it kind of becomes pretty apparent. When you look at we're taking a look at the volume compared to the open interest. And what you're now going to see is there's almost 50% of the open interest. There's 3 times the open interest. There's almost 100% of the open interest. That's over 100%. Here's 2 times the open interest, 2 times, 4 times, 5 times, 2 times at least. And then when you go look at the put side, volume to open interest, they're on both sides. Now, as an investor, what do you want to see? You want to see them on multiple strikes and on the call and the put side. Okay? What does that probably tell us? that it's not just one investor making a trade, that multiple investors are seeing opportunity. They're picking different strikes. Some are choosing calls. Some are choosing those pets. Now, let's go down to the monthly option. Let's just kind of see, well, are they going out? Now, by the way, the other thing we like to see is it's not just shorter dated options. Are they going out to those monthly options that have at least 20 or so days to expiration? Well, if we look at, let's say, the monthly options, the 21 March, 31 days, we look at kind of, that's more than 100%. That's 75%. That's about 35. That right there is 65. And we're not even done with the day yet. If you come over here to the put side, there's 50%. Okay. And that's what we see so far. That's the biggest one we see. Now, what you do also notice is, I don't talk about this, but sometimes you can get traders that say, look, I'm not just going to sell puts out of the money. Someone could be selling puts in the money. Now, wait, let's kind of talk about that. Let's imagine that we knew that these were selling options. We knew that 1,320 contracts, someone sold it. Well, what are they really thinking? Where are they thinking that the stock's going to go up to? Or do they think it's going to be flat? Do they think it's going to go sideways? Well, if you sell in the money put options, you are very, very, very bullish the stock price, okay? And you're really saying, I don't even mind with actually owning the shares at that strike price. Now, we're not going to follow that, okay? We're going to try to be a little bit more likely that we might not potentially have to buy the shares of the stock. Now, we know if we sell puts, okay, there's always the chance that we could be the buyer of the shares prior to expiration and or expiration. Now, what I'm going to do is I'm going to come down to not the 52 strike. That's where there's been pretty active. The second most active out of the money contract. So on the put side, when we say out of the money, we're saying the strikes that are below the current stock price. Now, the strike that actually is the second most active, it's going to be the 50. Okay. And what you're now going to notice is, now I want you to kind of notice, look at the premium compared to the stock price. Notice anything? Now, what you should be thinking is, man, what percent is the option premium? Okay. What percent is that option premium of the stock price? Can anyone tell me what that is? Now, if you said, wow, $540 and it's a $54 stock, you don't need a calculator. You know it's about 10%. Now, if it's 10%, where does it probably tell us that implied volatility currently is? It's really high, okay? Now, we would never say language like, oh, implied volatility, the higher implied volatility, that's better. Be very careful saying those words. You should say that it's more volatile. Okay. And so they're forecasting the stock could go up or down $18 in the next 31 days. And that's in the next 31 days. So that's why the investor might say, James, I'm going to be very careful which strike I pick. And the investor has to understand that having a defined risk, very important here, because if this direction is wrong, it could go way down. Okay. Now, when we look at, let's say, the volume, stock volume, explosive, okay? So it's not just all about finding price action, even though that's nice. But if we can find price action, but when we see stock volume, option volume, etc., that's just kind of more of an indication of other traders seeing it. Now, what I'm going to do in this case, so we can go look at another one, is we're going to sell the 50. Now, James, if you sell the 50, that's kind of a little aggressive. Fair. But what I'm going to do is if we sell the 50, okay, let's go back to the 31s there, 31 there, selling the 50. What we're going to do in this case is we're going to buy the 45. So if you sell the 50, okay, and then you buy the 45, that is really your classic short put spread. Now, I hope you asked me the question, James, why are you doing a put spread? Well, the put spread is actually trying to get a higher credit, okay? And if you do a put spread, short put spread, you're actually saying, look, I want a bigger credit. If you get a bigger credit, you get a lower break even, okay? And you're also trying to stay where it's kind of more on a probability type of strategy. If you look at the break even, if we sell the 50, we collect about $2 a premium, then we know the break even is about at 48 bucks. And there it is. It's about 47.90. Don't ever say the words "we're so far away right now." It'd be the words you probably wish you never uttered, okay? We're about $5 away from break even, or about 10%. And this trade is really for about 31 days. So what we're going to do in this case is we're going to sell, in this case, we could do about 2 contracts. We're going to sell 2 contracts, and there it is right there. Now, here's the deal. Graba actually says, if you're wrong selling puts, assignment might be imminent. It's always imminent, because someone would just have to go in, and if they're long the puts, all they would have to do is say exercise. We don't know what they have. We don't know why they're doing it. And frankly, it doesn't even matter, because an assignment is an assignment. So if you sell the put, the assignment is always imminent. Could be. It's a good mental thought process. Just plan on, if we're assigned, and in English, that just means that you have an obligation to buy 200 shares of stock at the 50. Now, wait, if I have to buy, how much money is that? Well, geez, that would be a good question to ask beforehand. Well, $5,000 to buy 100 shares, and if you did 2 of these, it'd be $10,000. So the question really comes down to is, do you have 10,000 bucks? Now, if I have to buy those shares, if they are assigned, do I have to hold on to them? No, you could try to sell all of them, sell some of them. You can hold them. It's up to you. They're your shares. So that's why liquidity is very important here, okay? Now, I want to kind of just, we're going to confirm send this. Note the credit there, less the commission. Now, also notice in this example, they're showing a little fee there, which is a little interesting, okay? So keep an eye on that as well. Now, what I'm going to do is, let me kind of flash through just a couple that we're going to keep our eye on. We know that, for example, when you look at Boeing, that's been the example that we've talked about quite a bit. We don't see the stock volume pushing, okay? But that stock is kind of going right back up to that 189 level. And I'm just going to, there it goes. That's the one that's kind of been fundamentally underperforming for a long time and technically, and it's going right back to the 189. This week, we're going to keep an eye on that. Got an example trade on that. This one might be one that it tries to break. We see cold dots, 1, 2, 3, which is just signifying higher lows on the chart. Now, you make a couple higher lows into the area of resistance, that resistance might not be resistance indefinitely. Now, if you take a look at also Goldman Sachs, which we also have a position on, Goldman Sachs did make a brand new high here today. The financial sector did not make a brand new high, but it is holding the old breakout level. Moving averages going green. Citi, and also another stock that we're going to be watching here today, above the old high. Could it be really making a higher low? Notice where we traded to here today. Doink, in the middle of a large green candle. Technicians call that the S1 level. Now, the other one we're going to also keep an eye on is PanW, okay? Speaking of tech stocks, PanW has already gone through its earnings already. It went down the day after earnings. Investors bought that. And what you're now going to notice is we're right back up against resistance. We do not see stock volume really surging yet, but why would investors buy on a gap down? Clearly, someone actually thinks that maybe the direction it took on post the earnings might be the wrong direction, and someone might be interested in purchasing it. Keep an eye on PanW. And last one I'll really bring up here is John Deere, okay? John Deere's kind of had some interesting movements here, which has led the industrials. That's a brand new high here today. The moving averages really on about Thursday at the close, Friday for sure. The moving averages were green. Today getting a little push here to a brand new high. So as a homework assignment, what I want you to do is to go out and look for examples where there is stock volume, high option volume relative to open interest. With that high volume, I want to have you practice doing cash secured puts and short put spreads on stocks that have higher volume, option volume, okay, and higher implied volatility. I want you to practice selling strategies on those. Now, I would ask you alongside with us, practice trading alongside with us. They're not recommendations, they're examples, okay? So our trades that we actually looked at here today was NVIDIA and SMCI, two semiconductors. Now, I also want to kind of make mention is when you take a look at, let me bring this something up. Sorry about that. Let me bring this up. Yeah. So if we pull this up, this is going to be the playlist for our class, okay? And so this is going to show you the previous classes that we have done. Make sure that you have the link that I just sent. That way you can just bookmark it. Second, I also want to make sure that you're aware of this webcast link, which is right there. And if we said, hey, who's coming up next? What you're going to notice is we have, in this case, on Tuesday, okay? And by the way, it's always a good reminder to refresh that. So it goes right to today's date, the 18th. And so we're going to see getting started with options. Now, coming up at 2 p.m. Eastern, so Cameron will come up next. Coming up about 2 hours after that, Barbara Armstrong will be coming up next. So stay tuned for that. So I gave you a homework assignment, and then also make sure that you have those resources available as well. So I'm out of my time here today. I want to thank you so much for your comments and your participation. Our focus was on option volume and volatility and selling strategies. Remember, with what we discussed, it was done for example, illustrative purposes only. Stay tuned for Cameron coming up next. Thank you, and thank you, Barbara. And also remember that Barbara is coming up today at 4 p.m. Eastern. Thanks so much. Take care. Bye-bye.